The countdown is on. Everything you need to get the edge at the end of the market day. This is The Close.
Stocks ending the week strong even as earnings season begins week. Live from Studio 2 here at Bloomberg headquarters in New York, I'm Romaine Boston.
And I'm Alex Steele. It's like yesterday never happened.
Yeah, I mean...
Nor the tech sell-off.
I don't want to ignore it.
You didn't see it because it's not here today. All right, let's get checking where our markets stand. S&P 500 is up by 1.2%. The Nasdaq has not recouped all of its losses from yesterday, but it is darn close, up by about 1.4%. Meta is not doing too well, but all the other Mag 7 are coming in pretty strong. The 2-year yield is down 5 basis points. That curve really steepening as we get that 210 spread really coming in there as you have more bets on a Fed cut, which is bringing down the long end of the bond market. All right, let's take a dollar yen here, down 0.6%. It's the constant rumor now of the BOJ, is MOF, I should say, actually intervening as you have that weaker dollar in a mixed G10 space remain.
Yeah, well, for once we have something to talk about other than tech. Earnings season kicking off. We got the big bank stocks earlier today. They are in focus, delivering at least 2 bright spots. One came this morning from JP Morgan reporting record profits, and 2 came from BNY Mellon posting better than expected net interest income. But the counterpoint, that came from Citi and it came from Wells Fargo, which each flagged concern about higher expenses. A closer look in just a second with the CFO of Wells Fargo. A closer look ahead as well of the manufacturing sector with the latest producer price index showing wholesale inflation still problematic for some companies out there. We also had an earnings report from Fastenal showing less pricing power as U.S. manufacturing remains in contraction. A combo ahead with the CEO of HVAC company Ferguson, and a lot of conversations today about that stunning and broadening rally in equities. The broadest rally right now in the S&P since late March, solidifying what looks like it's going to be a second week of gains. But unlike last week, when tech stocks led the charge, this week's gains, they've been dominated by everything non-tech. Real estate as a group up 5% over 5 days. Utilities, Alex, up about 4. Materials up about 3. And even financials getting a modest bid on the day as a group up about 2%.
You gotta wonder, is that sustainable? So let's get back to banks, because those trading heavy, particularly Wells Fargo. This was one of the worry spots for the company. Not only costs, but also when it came to net interest income and net interest margin. So here's the trajectory, right? If you go all the way back to the second quarter of 2023, fast forward to the second quarter of 2024, you see the slight decline there in net interest margin. That was really echoed in the net interest income numbers as well. The loan growth are a little bit of a question, and you also have deposit beta still there. It's less than maybe we had feared, but it definitely is still there, and that's squeezing that margin. The question is, how long does that continue for, Romaine?
Absolutely. Of course, 3 of the biggest banks already out with their earnings, Wells Fargo among them. Those shares down about 6%. Some concerns here about higher than expected costs. Some concerns right now here about a slowdown in cost-cutting efforts. Mike Santomassino joining us right now, the CFO over at Wells Fargo. And Mike, let's start off with the cost-cutting here. Some commentary in the press release, some commentary on that conference call about a slowdown in some of those efforts. Characterize us as to what exactly that means.
Well, thanks again for having me, Romaine and Alex. I appreciate it. Look, I think you got to look through into the quarter, and it was actually quite a solid quarter. We saw really good momentum in our fees, revenue-generating businesses that more than offset sort of what we saw as the expected decline in net interest income. We saw, headcount continue to come down and the core efficiency agenda still in place. We saw good capital return to shareholders. We saw our investments really start to pay off, in terms of that fee income I mentioned. And so there's a lot of opportunity there. On the expense side, it was really 3 things that sort of drove the increase in the full year guidance. First is revenue-related expenses in our wealth management business, which is a good thing because there's revenue that more than offsets all of that. And so as the equity markets stay higher than what we predicted earlier in the year, that is a positive contribution to earnings, but it increases the expense line. Second is related to some remediation costs that we have to put some of these client remediations that are related to some historical matters behind us, and that was in the first half of the year. And the third is the special assessment for the FDIC related to the events of last year. So when you look beyond those 3 things, the core efficiency agenda is still very much the same as it was last quarter, last year, and we continue to execute on it and feel really good about the opportunity we have there.
With regards to the FDIC costs and the other customer remediation costs, in theory, costs that should be temporary, are we sort of at the end of this path? Is there a light at the end of the tunnel when it comes to those issues?
Yeah, well, I think the remediation stuff was related to a couple matters, they're historical, and so we're nearing, we're closer to the end on those than we are otherwise. And on the FDIC, that'll be driven by the losses that we see ultimately through the FDIC fund there, but we've accrued for everything we know about there, and we'll see how that progresses. And so it shouldn't, we don't know that it'll be any higher than it's been, and so we'll get more information each quarter from the FDIC.
Hey, Mike, the other part of the quarter that disappointed the street, though, was net interest margin, net interest income. And a big part of that is going to be that loan demand. Why do you guys still see that loan demand as tepid when a lot of your peers don't see that? What is it specific to Wells Fargo?
Well, I think, keep in mind that the guidance we put out there for the year is the same guidance we put out in January, down 7 to 9%. We just said at this point in the year, we think we'll be around 8 to 9% versus anywhere else in the range, and so the guidance is still about the same. So most of what was in there actually was very similar to what we expected to happen. Loan growth has definitely been a little bit weaker than we thought as we looked at the beginning of the year. And I think that's generally the case in a lot of other places as well. And I think we've been very, very consistent about our underwriting standards and the way we're approaching it. So we're not out there chasing growth by taking more risk. We're actually very much just being very consistent over a long period of time. But underneath the NII trends, you're actually seeing some positive trends. Deposits are up, in all of our lines of business versus the first quarter. That's the first time in a couple of years that's happened. And so there's actually some positive trends that are happening underneath there as well.
I mean, I hear you, but the stock is still down 6%, and it's even off its lows versus your peers. Like, there's clearly something that is worrying investors, and those cost measures as well as net interest income were those two worries. What do you think happens to loan growth and net interest income as the Fed may cut rates?
Yeah, well, as the Fed starts to cut rates, our deposits will begin to reprice downward as well, particularly on the wholesale side. So that'll be a positive as you start to see, that happen. And I think rates are one part of the equation for what we hear from our clients, right? So you have the election coming up, you have rates still being high, you have some uncertainty still out there in the economy to make sure this soft landing is really going to materialize in the way people think. And so I think as we get through the year, you'll start to see clients do more from a lending perspective, as well as consumers. If the stronger the consumer stays, I think you'll start to see some more growth there as well.
Mike, I have to ask you about some of the efforts that Charlie Scharf has made to kind of broaden out this business. Obviously, Wells much more known for the consumer side of that business, the mortgage side of that business, but you've made some decent strides so far in the trading space and, of course, in some of the more traditional Wall Street types of businesses here. How do you accelerate that, though, in a way that is going to satisfy investors?
Well, I think it's not about acceleration. It's about being very consistent in our execution there. And I think, we've been talking now for a number of years about a few areas of investment. First is the credit card business, and I think you see that come through, the new accounts and the growth in balances there. Second is the wealth business, where we've, again, seen growth in the advisory fees. We've seen, our attrition in advisors slow, and I think that, we think there's opportunity to continue to grow there. And then it's in the corporate investment bank and the commercial bank, and I think we've been hiring and investing in people and capabilities there for the last few years, and I think you're starting to see that really come through, both in the trading line and the investment banking fee line. And I think that's something that will kind of build methodically over time. There is no trying to accelerate by taking risk. We have to be very consistent about how we go about it, and I think we're starting to see the benefits of that come through.
Mike, we really appreciate it. I know it's a busy day. Thank you for taking the time. Wells Fargo CFO, Mike Santomassino. All right, let's bring in Gerard Cassidy for more insight into the bank earnings, Managing Director and Head of U.S. Bank Equity Strategy over at RBC Capital Markets. Gerard, you have a sector perform rating on Wells Fargo, for example, with a $61 price target. What do you make of the shares down 6% right now?
Thank you, Alex. I think what you're seeing is this stock, Wells Fargo, has had a nice run this year, and there's probably some profit taking going on. And as Mike just pointed out, obviously the guide on the net interest income As he pointed out, it was 7 to 9%, which was the start of the year. They're kind of edging it up closer to 8 to 9. And I think that had a lot to do with why maybe some people are taking some profits right now in the stock. Plus the guide, slightly higher operating expenses. Again, as he pointed out, not the core expenses, but these ancillary expenses. That was another disappointment, which is contributing, I think, to the weakness in the stock today.
Gerard, the one thing that all these banks didn't have the ability to do with the quarter is look at the CPI on Wednesday and what the market was going to reprice, and Fed Chair Jay Powell 2-day of testimony. If they could go back in time, like what is sort of a rate cut that comes in September, November, 50 basis points this year? What does that wind up doing to how much money these guys can make?
In fact, I think it's going to be very positive for all the banks, including Wells Fargo. And Mike touched upon it a moment ago, where you're going to see funding costs start to come down for the banks. And so if the Fed does cut in September and December, and let's assume they cut 2 or 3 times in 2025, if we see 100 basis points lower Fed funds rate by this time next year, Wells Fargo and the other banks' funding costs will be falling. Now, what's also important, though, to point out, many of these banks put on their books back in 2020 and 2021 fixed income securities, as well as some fixed rate loans, anywhere between 1% and 3% coupons. When those loans and fixed income securities pay off, they're going to be reinvested at higher yields. So the margins are actually going to improve, and that would be very positive for Wells, because remember, they still have that asset cap. So the other banks can grow their way through the pressure on the margin. Wells, of course, cannot.
Yeah, absolutely. And this has been a long road. Of course, Charlie Scharf now in his 5th year there trying to make this turnaround. I do want to ask you about another bank that is sort of trying to make a turnaround, and that's what Jane Fraser has been doing over at Citigroup here. Earnings today, I thought were actually looking pretty good, even though the shares are down. Just give us a ranking here, not only of what transpired in the most recent quarter, but how you kind of assess what Fraser has done so far since she took over.
I think she's done a very good job. She's done much better than her predecessors in trying to streamline and simplify the bank. It's a very complicated, long task. This is not going to be fixed in a 12 or 24-month time period. It's probably a 5-year fix from the day she started until maybe it really is finished. And of course, as you know, next year, they're planning to spin off the Banamex subsidiary, which is their Mexican subsidiary. But so I think we got to give her some real positive credit, even though I know there's criticism out there that it may be not going as fast as it should, but she's made real progress. And there was a setback this week, of course, as you saw with the regulators coming out, not being pleased with the progress they're making in some of the controls and procedures area in data management. And that was, I think, part of the reason the stock is down today.
We only have about a minute or so left here, Gerard, but I do want to push ahead to next week. We're going to get Goldman, Morgan Stanley, and Bank of America. Is it going to be more of the same, or is there a different narrative coming out of those stocks?
No, Romain, I think one of the highlights today that we really haven't talked about is the strength in investment banking and trading. And as you just pointed out, Morgan Stanley, Goldman Sachs, Bank of America, we expect to see really good numbers from those companies. The investment banking numbers year over year, we're seeing 30, 40, 50% gains. And in trading, what's interesting is the trading numbers are coming in better than expected. That's both fixed income and in equity, and especially in equity trading. And even for Wells, as they pointed out, their equity trading numbers were quite strong on a year-over-year basis.
All right, Gerard, got to leave it there. Always great to talk to you, and thanks for honoring our Seersucker Friday dress code here. Gerard Cassidy, the best in the business, Managing Director and Head of U.S. Bank Equity Strategy at RBC Capital Markets. A lot more coming up here on the big program, including a closer look at AT&T disclosing a massive hack attack that actually took place last year. But now a lot of questions here about what it could mean for customers and, more importantly, shareholders.
Plus, we're going to get a read on the economy from Kevin Murphy, CEO and Executive Director of Ferguson, the wholesale distributor of everything from ventilation to heating systems for residential and office buildings.
And Alex, if you had a chance to work from home, would you work from New York City or would you work from the French Riviera?
Obvi, the French Riviera.
Affluent Americans with that flexibility are finding that, well, they are snapping up luxury homes out there in Saint-Tropez and other cities along the French Riviera. We're going to take a look at, well, what that's doing to housing prices out there. That's coming up in just a bit, right here on The Close on Bloomberg.
Seeing buying in the front end of the curve here. You have the 2-year yield down 17 basis points in just the last 4 days. Barclays now saying, though, the 5-year Treasury is what you want to be shorting right now, saying that markets are pricing in too many Fed rate cuts. They specifically go on to say that the continuity or cumulatively, which is not consistent with the resilient economy and inflation risks following the U.S. elections, adding that 200 basis points of rate cuts are priced in, implying an endpoint well below prevailing estimates of the real neutral rate. Here with her perspective is Tracy Chen, portfolio manager over at Brandywine Global. Tracy, do you agree? Time to short the 5-year?
I disagree. I think their theory pricing too much of the cut. I do think that this round of cut will be shallow, and because the U.S. economy is just probably experiencing a soft patch, and I don't see a recession imminent at the end of this year.
Do you feel that so when do you think we're going to get that rate cut, and how many this year then? Because it looks like we're starting to fully price one for September and 2 fully priced in by December.
Yes, the market priced in probably 2 to 3 cuts. Given the tamer inflation and softer growth, I think probably one cut or 2 cuts. I think 3 cuts is a little too much.
I'm curious that when you look at some of the moves that we've seen this week, particularly in the fixed income space, presumably on the back of that CPI report, presumably on the back of some of the comments that Jay Powell made at that testimony here, do you think we are now finally going to see that upswing that we've seen, the disinversion of the curve, the idea that rates will now reprice to something that, I don't know if it's in line with the Fed, but certainly a little bit more appropriate to economic conditions?
Yeah, I think we do believe there should be a steepening of the curve, and because the long end of the curve will face a lot of pressure. So cyclically, we do believe the Treasury rate should have a strong rally, but in the medium term to long term, I think the long end of the curve will face a lot of structural forces in terms of headwinds. For example, if in the medium term, if Trump wins the election, I think there will be deregulation and more tax cut, and then more tariffs, and those are mostly inflationary. And structurally, for the long term, I think the fiscal indiscipline will have to be fixed. Otherwise, there will be a lot of supply on the long end and also the short end. So, and in order for investors to be attracted to the Treasury market, you do need a higher term premium, which are not priced in yet. I don't think the market fully priced in a higher tariff environment.
Yeah. Why don't you think we've seen that term premium come back, or at least come back to a level that's a little bit more satisfactory to investors? Because everyone brings this up, but no one seems to have a reason or explanation as to why it continues to just sit where it's at.
I think people more focused on the cyclical, the short-term cyclical forces, because if you look at the Citigroup Economic Surprise Index, it dropped very sharply to negative 43. I think we do compare the 3 economic regions like Europe, China, and U.S. The economic surprise dropped the hardest, and mostly driven by soft data rather than hard data. So the sentiment really dropped a lot. But if you look at Europe and China, they all dropped, but not to the degree compared to the U.S. So the U.S. exceptionalism is in doubt right here. So we do see a converge of the global growth. The slower growth, Europe might catch up with the U.S., and U.S. growth might slow down more than other economic regions.
Going back to the spread now, just sort of encapsulating what we've seen this week, because we have a lot of moves in the bond market, particularly that front end. 2-10 spread is just negative 27 basis points. If you look at the long-term average, it's a positive spread of something like 87 basis points, something along those lines. What do you think that spread realistically gets to with the outline and the growth perspective that you just talked about?
I think they will eventually go positive. If not this year, probably early next year. And I look at each different segment of the rate curve. I think originally 6 segments of the rate curve, they were all negative, and now 3 of them turned positive, and we have 3 more to go. So I do think the curve steepening should go on. Actually, my conviction on curve steepening is stronger than the absolute level of the rate itself.
All right, Tracy, great stuff. Always great to talk to you. Tracy Chen, portfolio manager over at Brandywine Brandwine Global. And this gets to this idea now here of like whether the bond market is going to really start to drive the narrative a lot more for the equity market, because it seemed like for the last few weeks, maybe the last few months, the equity market was kind of left to its own devices, and it was just basically just like a frat party for the last 2 months.
I know, but the frat party continues today.
Yeah.
Like you got the Russell, so okay, you can make the argument for the Russell and for the bond market, but that frat party for tech, that still continues. Yeah, absolutely. Here, you're definitely seeing that here on this day with stocks right now near the highs of the day, setting up for what's going to be a pretty stellar week across the board for the major industries. We are taking a look at some of the individual movers on the day, and there are some that aren't participating, and that includes names like HubSpot, those shares extending declines on a downgrade and a street low price target over at KeyBank. We're going to have more on that in our top calls after the break, right here on The Close on Bloomberg. All right, let's get a view from the sell side with our top calls. The big movers on the back of analyst recommendations, and we're going to start off with HubSpot, having a rough go of it today. Shares of the software company down for a sixth straight session, with KeyBank today slashing its price target to a street low $460 a share. The analyst citing management departures and cuts to partner resources, and that decision by Alphabet to walk away from plans to buy the company isn't helping perceptions either. Those shares down about 4%. Next up, Booking Holdings flying higher today after an upgrade to buy over at Benchmark. The analyst says increasing resilience in Europe and the Middle East and better than expected growth in Asia and Latin America, fueling confidence that Booking can outperform consensus. The price target, which they actually haven't had one over at Benchmark since 2017, set at $4,700 a share. That implies about a 16% upside from where it is today. And finally, let's take a look at Eli Lilly. UBS raising its price target to a street high $1,100 a share. The analyst expects expanded consumer access for weight loss drugs and for Lilly to improve its supply chain enough to meet that demand. Those shares up about 1.7%, 949.83. That's a record high, and those are our top calls. Just coming across the terminal right now, everyone. Barclays changing their Fed forecast to 2 cuts now in 2024 from 1, and this comes as JP Morgan also upgraded their cut forecast to September from November. Is starting to trickle in. So staying with the economy, we're going to talk to Kevin Murphy, CEO and Executive Director of Ferguson next. It's an HVAC company for residential and non-residential. We'll break down what he sees on the inflation and growth front. This is The Close on Bloomberg.
Just about 3:30 p.m. here in New York. This is the countdown to the close. I'm Romaine Bostick.
And I'm Alex Steele. Yes, it is the kickoff of Banks Day, but one company that we both like, Fastenal. It's literally nuts and bolts.
Yeah, I mean, they're basically, if you own a factory or a warehouse or something, you're probably buying stuff from them, nuts, bolts, racks, whatever.
Yeah.
So it's always a nice read on the industrial economy. And we talk about an industrial economy, at least a manufacturing economy. It's effectively been in contraction now for at least a year and a half. I was looking at the ISM data, something like 19 of the past 20 months we've had contraction readings. And the one interesting thing, though, about the Fastenal earnings, they weren't great, but it seems like people are hanging on to this idea that maybe we're at that proverbial trough, maybe there is a rebound ahead.
Yeah, and it was less bad. Like that was definitely the takeaway. And also, you had a better volume, but not as great pricing. Okay, a little bit on the top line, even though the pricing that they could take wasn't that great, but less bad.
Because I thought it was interesting when they talked about how their own pricing power was eroding, but then it came on the same day we got that PPI report that seemed to suggest wholesale pricing to a certain degree is still kind of problematic for other businesses.
Margin crunching.
It's interesting to see where they kind of fall into that in that balance.
Well, let's see what another company falls in that balance. And this is Kevin Murphy. He's the CEO of Ferguson, the perfect person to talk to about this. It's basically an HVAC company that makes everything that you need inside a building for residential and non-residential. Kevin, let's pick up on that on the pricing part. So we had PPI that came in hot, CPI coming in weaker. That says to me that's going to squeeze your margins. What are you seeing?
Yeah, first, thanks for having me. And yeah, the macro markets are a little bit challenging. You look at our business, we're a little over half residential, a little under half non-residential. And from a pricing perspective, we've actually seen our product categories move into deflationary territory. So we had roughly 2% deflation during the last quarter, but we were really pleased that we're back to volumetric growth And when you talk about the ability to pass price through and pricing power in the market, we were pleased to see gross margin expansion, even though we were in price deflation. So we believe we're back into a place where we can start to volumetrically and build that organic curve.
Why? How? Is it because the demand is so strong, so you have that pricing power? Is it because that disinflationary impulse has come in so much? What do you attribute that to?
So the deflationary pressure that we're seeing actually comes through in commodity-based input products. So think about PVC pipe, copper tube, iron pipe, steel pipe that we use across residential and non-residential applications. And if you look back to, call it the fall of 2020, before the inflationary pressures really started, that's what led us into that inflation. We saw it in, call it September of 2020. Well, now we're seeing those commodity-based inputs go into deflationary territory. And so it really is just getting back to a reset, back to an equilibrium. And so from a pricing perspective, we're still able to charge for the value that we provide to the contractors in the marketplace. And so we were really pleased with that margin performance, and especially now that we're back to volumetric growth, even though the markets still have a little bit of chop left in them.
Kevin, I am curious about just what the mood is among some of your clients in general. I mean, we can look at the numbers and get an assessment of where we stand in terms of production or lack of it thereof. But like, what are they feeling right now when you talk to those folks or your team talks to those folks?
So both residentially and non-residentially, the contractor base still feels like they're in a pretty good place. And part of the reason for that is we have a serious deficit of trade professionals inside of America. We're over 300,000 workers short in terms of trade professionals in this country. So that's a real challenge as we look to grow our economy in the future. And so their business is still in a reasonably good place. And if you look at the markets that we compete in, yeah, we've got some pressure with interest rate and overall housing price, for example. But we're underbuilt in the United States by, call it, 3 to 4 million units on the residential side. The average housing stock is 40 years old. And then on the non-residential side, with stimulus from fiscal spending and what we're seeing with onshoring, reshoring, and data center activity, there's really good tailwinds that are going to be supportive, despite what you're seeing with office and knock-on commercial construction. So they're feeling pretty good about where the market is. We've just got to get through some near-term chop as we start to make our way.
Yeah, it's interesting. There is a lot of optimism about some of that build-out, certainly in terms of the money that's been committed to it. I do want to go back to what you were alluding to on the labor side of it, because there is some concern about having enough skilled workers to fill up some of those facilities once they do get built. What sense do you have that, whether it's at the corporate level or the government level, that there is a plan in place to, I guess, fill that void, if you will, whether it's training up folks here in the U.S. or finding workers from elsewhere?
I'm optimistic that we're starting to see the conversation turn. I would love to see us have a nationwide kitchen table conversation with parents that say getting into the trades is a great way to grow a career, a great way to become an entrepreneur, and to really make a living as you go forward in the U.S. Because it is going to be a stable piece of employment that is critical to what we do to build out our infrastructure. We're involved from a corporate perspective in places like MicroWorks, Women in Plumbing and Piping, and at the grassroots level, really trying to advance that as a career for men and women in the United States.
Hey, Kevin, going back to sort of the macro environment for a sec, we're all sort of anticipating that Fed rate cut. What happens to your business in non-res and res if we get that rate cut this year?
So on the non-res side, we've still got, like I said, those tailwinds from really large capital projects, data centers, chip factories, onshoring and manufacturing. That's in play, that's running. If you look at the residential side, get past the election, have some rate cut and easing of housing affordability, and we think that we'll see some continued growth. Single-family construction is in a reasonable place just because we're not having existing, home turnover right now, and so new construction is a good place to go. We think we get to the back half of this calendar year, the remodel side of residential begins to pick back up steam, and with a few rate cuts, we'll see that new residential construction, particularly single-family, start to get back to growth.
Kevin, is that a risk, though, weirdly? Is like you get rate cuts, all of a sudden, boom, you get the demand, you get a lot of growth, and that's going to trigger some more inflation, and we're going to get into a different spiral. Like, is that something that you can see?
Yeah, for us, we're looking at, like I said, commodity-based input deflation in the price category helps with affordability, but quite frankly, unit construction starts to get at the affordability concern. We need to build more housing stock in the U.S. We need roughly 1.5 million units built per year to take care of new family formation, immigration, disaster recovery, second homes. So we've got a ways to go, and we need to get back on that track to building housing stock in the U.S.
All right, Kevin, great stuff. Always great insights. Kevin Murphy over there at Ferguson, the CEO, major HVAC company here. A closer look at the manufacturing economy here in the U.S., Alex Steele. And I mean, it's funny, you know, I mean, I guess we're not really a manufacturing economy anymore, but it's still very critical, particularly for the health of the markets and to a certain extent, I think just our general psyche about how things are going.
Yeah, I was going to say, critical to the markets, whereas the consumer is critical to the economy, if we look at it a little bit bifurcated along those lines. But I thought that was interesting that inflationary impulse is now totally turned around when it comes to commodities. It's still disinflation, and that hasn't kind of risen up yet, despite sort of PPI maybe getting a little stickier over in China because of freight costs, et cetera.
But does this, I mean, I don't know if we're supposed to say this out loud, but is this the balance that I think Jay Powell was kind of alluding to?
Well, you're Goldilocksing it on me, aren't you?
I'm not, you know, I don't want to use that word, but you know, that's a four-letter word around here. But I mean, but he did kind of get at something that I think we're all wishing for. I don't know if it's true, but I mean, you know, Jay Powell's a smart guy, so if he says it, I would think he has some sort of fundamentals to back that up.
And then to Ferguson's point that Kevin Murphy was making, like, well, if you wind up having rate cuts, you still have housing and they have the growth there, and then you have demand, but we need it. We need the supply, so it's okay. That's going to even out. You're not going to get that inflationary impulse that some are worried about. Yeah,
great conversation coming up. Another great conversation. I don't know if you've heard about this, but AT&T apparently they had this massive data hack, but like most data hacks, you know, we don't hear about it until months after the fact. It actually happened last year. We're learning about it now. The stock moving just a bit on that as an FCC investigation gets underway. It's our stock of the hour. The discussion up next. This is The Close on Bloomberg. Welcome back. It's time now for our stock of the hour, and it is AT&T not participating in today's rally. This after the company announced a massive hack of customer data. That breach included records of calls and texts for almost all of its mobile phone users for a 6-month period back in 2022. The Federal Communications Commission here in the U.S. now saying it's investigating that breach. Chris Palmieri joining us right now to talk a little bit more about what we know. And Chris, I just want to start off. There was an interesting post on X from John Scott Ralton, who's a big sort of a researcher in the cybersecurity space. And he basically said that this basically gives whoever got this data, in his words, NSA level view into Americans' lives. Is this breach that severe?
Scary. I mean, what's shocking about this is how widespread it is. It's virtually every single AT&T customer. Landlines were involved as well, and other companies that are connected through AT&T cellular networks. So, you know, just a huge audience there. And as AT&T itself noted, that although personal data isn't involved, the phone numbers are, and you can sort of trace back and see whose numbers they were and figure out virtually who's talking to whom across the country during those 6 months.
Do we know anything about who issued the attack? Did AT&T pay to not have the data released? Do we have any of those details yet, Chris?
They haven't said anything about any ransom. It was a workspace, AT&T connected through a third-party vendor, which they've identified as Snowflake. So you can imagine maybe somebody getting credentials and pretending they're an AT&T employee, something like that. There's a lot of question as why, if this was known in April, why we're just hearing about it now. The FBI has said that they've actually delayed disclosure for security reasons, and so a lot of speculation then that, you know, that they have somebody that they've in custody or and apprehended in connection with this, and maybe more, and that they feel like it's contained. The information wasn't distributed publicly, and so for those reasons, it may be, you know, all wrapped up, but it's still very scary.
It's very scary, and it gets to, I think, a question that a lot of us has, Chris, is, did this cause any disruption? Do we know if it caused any disruptions around the time it occurred? And more importantly, I mean, what happens to all these folks? I mean, they're going to have to like change their numbers or get new identities, or, you know, what?
Yeah, I don't see, you know, I don't really see how you can erase the history of those calls. I mean, if we believe them now that it hasn't been leaked publicly, hopefully it's contained. But this just seems to be almost a monthly event. I mean, it was just in April too that AT&T disclosed another hack, and we've got a list of all the big carriers experiencing this kind of stuff.
Yeah.
So it's just, no, it's not as easy as just watching your credit card or something.
All right, Chris, we really appreciate it. Thanks for hopping on with us on this. Chris Palmieri of Bloomberg joining us. I was speaking to John Butler of Bloomberg Intelligence. He's not worried about churn. He's more worried about, will the reputation damage in the short term prohibit people from going to AT&T because they're so freaked out?
Yeah, the problem, though, is like, I mean, not to speculate, but I assume every carrier deals with this from time to time, maybe not to the extent that AT&T, but I feel like you said, it seems like once a month or something we hear a major company basically saying, somebody who shouldn't have our data has our data. I mean, how do you solve this?
I mean, landline, though? That's something.
So go back to a landline?
No, they still took your landline information.
Right.
Like, that was so freaky. All right, we're going to count you down to the closing bells. We're losing a little bit of steam as we head into the close. We are no longer at a record high for the S&P. Kristina Hooper joins us next.
One of the highlights today that we really haven't talked about is the strength in investment banking and trading. And as you just pointed out, Morgan Stanley, Goldman Sachs, Bank of America, we expect to see really good numbers from those companies. The investment banking numbers year over year, we're seeing 30, 40, 50% gains.
Gerard Cassidy, head of U.S. Bank Equity Strategy over at RBC Capital, kicking us off to the close just a little while ago. Romain Bostic here alongside Alex Steele with about 10 minutes until we get to those closing bells. Alex and, of course, Gerard, talking a lot about those bank earnings that we got this morning. Kind of a mixed bag here. I mean, J.P. Morgan, as always, record profits. What else is new? But the other names there still kind of in flux.
I mean, Bank of New York Mellon, though, having an amazing quarter, up by 5%. Wells Fargo, worst performer still on the S&P. I should point out, we're rolling over here from that top of the S&P. We are no longer sitting at a record high, although the Russell 2000, yes, off its high, still holding on to some of those gains, up by about 1.3%.
Yeah, interesting, too, like the complexion of this. I mean, even if we do get a little bit of a selling into the close, we're still talking about a pretty decent week for the major indices, and probably a big story on this week here is that rotation a little bit out of tech and into, I guess, some things non-tech. Real estate, your best performer as a sector on a weekly basis. Kristina Hooper joining us right now. She's the Chief Global Market Strategist over at Invesco. And Kristina, I do want to start off with that rotation. I mean, we'll just call it that. I know it's only been a few days of rotation here, but there was an opening that this market had been looking for. And you really saw that in force over the last few days, where when they got that signal that maybe rates, the Fed rates, would come down, maybe economic conditions would be cooperative, you saw an embrace of cyclical, you saw an embrace of materials, you saw an embrace of interest rate sensitive stocks.
Absolutely. The market is assuming that the Fed will act soon enough that we will avoid any kind of more serious economic slowdown, and that we're likely to see a reacceleration in coming months. So that's what markets are betting on. We've had this happen before, though. So it's a question of whether or not we actually see the follow-up by the Fed in enough time for us to prevent greater problems, because right now we're seeing cracks that we hadn't seen before. So time is of the essence.
Do you have confidence, though, that the Fed will act soon, or at least will signal that they're going to act soon? Because that was the chorus particularly coming out of that last, the CPI report. But even when Powell was testifying, a lot of people were saying, look, the time to do it is now, and just do it. But we're probably not going to get it in July, and I'm not certain we're going to get it in September.
So I still think there's a good chance we get it in July.
Really?
And I think if Jay Powell is wise, the Fed will move in July. It will be viewed as less political than doing it in September.
Interesting.
For one reason. But I also think it's because the data argues for it, and monetary policy conditions are just so restrictive. If we look at the gap between core PCE and where the Fed funds rate is, it's the largest gap since 2007. Which is rather ominous. And if we were to look at the proxy Fed funds rate that San Francisco Fed runs, factoring in other monetary policy tools, it's at about 6.4%. That's way too high given how much progress we've seen in disinflation.
I'm curious, though, a hypothetical that if they were to cut in July, A, you think that would be just 25 basis points, and two, does it not matter that that wasn't telegraphed in advance? Because if he did cut, that would be a surprise.
Well, he still has a few weeks to telegraph it, but I will admit, I think it is unlikely he does it. I think it is, though, the right thing to do, and I do think he has enough time to telegraph it.
Gotcha.
So going to the small cap and the rotation situation, Chris Harvey over at Wells Fargo had a note out that talked about kind of what you need to really sustain that kind of rally. He said, we believe the great rotation needs lower rates and earnings optimism. He says the CPI delivered lower rates, but earnings concerns linger. Just look at Delta, for example, and we see an oversold bounce, not a rotation. The best risk reward appears to be greater rate sensitivity. We got one, but not the other, because earnings might not hold up. And then in small caps, you can make the same argument.
So I think earnings will hold up once the reports start rolling out. We've seen a very, very benign downward revision season thus far. So from March 31st to June 30th, we saw a very, very small level of downward revisions, much lower than what we normally see. So I suspect that we're going to have a relatively good earnings season. What we have to worry about is going forward, right? The banks have signaled that with increased loan loss provisions. We're seeing a lot of signs that the economy is weakening from here. And that, I think, is the bigger issue. That's the one that the Fed can remedy by acting sooner rather than later.
So under that environment, though, like small caps could do well. It's so hard for me to understand, like the economy is weakening, so buy small caps.
Because markets discount in advance.
Yeah.
So markets are saying this is what's likely to happen by the end of the year. We'll see an economic reacceleration, so we're going to buy on the rumor.
Fair enough.
I have to ask you about politics, too. I mean, you mentioned kind of how the Fed might want to try to steer clear of the November election by maybe getting these rate cuts started before then here. What about for investors overall? There's been obviously a lot of speculation about the policy differences between the two candidates, and obviously a lot of concern that one candidate might not end up being a candidate, depending on how things shake out. Do you avoid that as an investor right now, or do you try to position around it already?
I think you have to put on political blinders and assume that that is all noise. And history tells us that is noise, that, you know, we could certainly see some very short-term volatility, but it doesn't matter for the longer term. So it's really important not to get spooked by what's going on in politics. The easiest way to do that is just put on blinders, stick with one's investment policy, and not let it change because of what's happening.
What are clients, though, asking you about right now when they come to you and your team with their worries, their hopes, their dreams? Like, what's kind of at the top of the list?
Well, I think it's a combination of when will the Fed act and are we headed for some kind of recession? You know, interestingly, those are the questions that have popped up rather recently. I think for a long time, many were comfortable with the idea that the U.S. economy was very resilient. That's starting to change a bit. And some of the data certainly is suggesting that. If we look at most recent ISM PMIs, but also if you look at the University of Michigan preliminary consumer confidence data for today, that came out today, that is telling us there are concerns, and that's certainly what's bubbling up in client questions.
Yeah, and it was interesting too in that UMich data to see kind of the difference between high-income folks and lower-income folks. Definitely more pessimistic at the lower end of the income spectrum. Kristina, we have to leave it there. Great to have you. Kristina Hooper, Chief Global Market Strategist over at Invesco, with about 3 minutes until the closing bells. Alex, still green across the screen. A decent day, a decent week, but some selling into the close. It
is. Also, it's interesting the UMich point that you were talking about. Inflation expectations came down, and yet everyone still felt worse. That was a head scratcher.
And that's the conundrum, though, that the Fed has to deal with, right? I mean, there's what the data tells you, but there's also, and we heard this, decades ago, right, from James Carville, right? The economy is a feeling for a lot of folks. And it's not a data point.
Yeah. You know what's not a feeling? The equity market.
Well, the equity market, you're getting your gains here today, 56.14, of course, off the highs of the day here, but still shaping up for what is going to be a second week of gains for the broader market as we move closer to those closing bells. Our full market coverage, it starts right now on Bloomberg.
The Closing Bell, Bloomberg's comprehensive cross-platform coverage of the U.S. market close, starts right now.
And right now, we are 2 minutes away from the end of the trading day. Romaine Bostic here with Alex Steele, taking you to the closing bell. Our global simulcast starting with help from Scarlett Fu, Carol Masser, and Tim Stenovic in the radio booth.
They're back.
As we welcome our audiences across all of our Bloomberg
Did you
platforms.
miss us?
We did miss you, and I hear that both of you guys are a little under the weather. So if it's okay, Carol, I'll do all the talking for you. Is that all right?
Oh, like it's anything different from before?
It's a day that ends in Y.
I'm just going to say we brought some of the green home to Wall Street. That's all we're going to say. Because we see pretty broad-based rally, guys.
Yeah.
Yeah, go ahead, Romain. I thought you were going to talk.
Carol, you set it up for me here. But we talk about those moves here, and the idea that you did get that rotation this week, a rotation that I think a lot of people have been pining for quite some time. I guess the big question is this going to be one of those situations where it all unravels when we come back on Monday?
Yeah, but the data confuses me because you have consumer prices, of course, cooling. That's what we got earlier this week. But then today we got wholesale prices that rose more than anticipated. So how do you square that?
Well, yeah, and we were talking earlier about how UMich came in lower, but then the inflation expectations also came in lower. So some of these things may not quite be adding up. But guys, I gotta say, it's really hard to sort of poo-poo the rally when the Russell 2000 is still having an incredible day. Like, it's off its highs, but still, it's up 1%.
And an incredible week, too.
Yeah, because what did you say, Carol? 6% for the week?
6% for the week overall.
Yeah, so a big rotation yesterday out of the mega cap tech names and into those small caps.
And we should point out on a weekly basis, it looks like it's the strongest outperformance we've seen from the small caps going back to April of 2020. Of course, a lot of that aided by the big drop that we had in yields, a big drop in the dollar as well on the day and on the week. As for the day, here are your numbers. A Dow Jones Industrial Average in the green, higher by 0.6%. An S&P 500 in the green, higher by 0.6%. A NASDAQ Composite also in the green, higher by 0.6%. Your outperformer on the day, trying to separate itself, is the Russell 2000, a 1% gain on the day. Mid caps and transports also higher as well.
All right, so I'm just looking at the Russell 2000 since we're talking so much about small caps. Most names in the index today, over 1,400 to the upside. If we go to the big caps, Scarlett, same thing. It's pretty broad-based rally. You've got almost 400 names to the upside in the S&P 500.
Yeah, absolutely. Very broad-based advance. Look at the 11 sectors. The only sector in the red right now is communications services, which admittedly is fairly big because you've got names like Facebook in there, or I should say Meta, but it's not one of the decliners. You've got Netflix and Paramount dragging that particular industry group lower. As for the big gainers, consumer discretionary, materials, and technology all up by at least 0.9%.
All right, let's get to some of the individual gainers, if I may, in the Friday trade. I know we talked a lot about, obviously, the big banks because they kicked off the earnings season in a big way, but most of those names finishing lower today. We'll get into that in just a moment. Here's a gainer, though, in the financial space, and we're talking about Bank of New York Mellon, up about 5.25% in today's trade. It's the nation's oldest bank. They reported second quarter adjusted earnings per share that came in ahead of consensus estimates. So investors kicking that one to the upside. We saw a lot of movement in the EV space when it comes to some of the share names. Tesla, a gainer in today's trade, up about 3%. It was a top gainer in the NASDAQ 100. That's despite a UBS downgrade on concerns that the company shares have risen too much too soon, on optimism over its AI plans. There was a lot going on, but nonetheless, this analyst cutting it to a sell. 12-month price target was raised, though, to 197 a share. So very interesting. So nonetheless, though, Tesla now performer in today's session. I mentioned the EV space. Here's another one that saw some move to the upside. EVgo, shares jumping as much as 20% in today's session, finishing with a gain of just shy of 19%. Benchmark raising the price target on the $1.1 billion market cap operator of EV charging stations to $5 from $3 a share, talking about increased charging network utilization and a recent positive shift in market sentiment. And one more, because we like the nuts and bolts when it comes to what's going on in our economy. And a great read on that was Fastenal. That company up about 2% in today's session, off its highs of the days. This company coming out and it posted inline profit and sales for the second quarter. So earnings season definitely underway here.
Okay, this one's not on my list of decliners, but we do have a headline from Meta Platforms, which did finish the day down by 2.8% today in the after hours. Not moving much, but I'm talking about it because we have a headline that Meta has removed Trump account restrictions, this according to Axios. As a reminder, following what happened in January 6, 2021, Meta Platforms, in addition to other social media companies, Twitter at the time, put restrictions on, at the time, the president president's account there. He's certainly the front runner. He's not the official nominee yet, but that is coming very soon. We'll continue to bring you updates on that story as we do get them. Let's get to some other movers, though. Other decliners. Carol did mention some financial institutions that did move higher. I got ones that moved lower on the day today. I do want to start with shares of Wells Fargo, which actually saw their biggest drop since last year's regional bank crisis. Second quarter results were hit by higher than expected costs. Shares today fell by just about 6%. Expenses for the quarter climbed 2% to $13.3 billion. It was higher than the 0.2% increase that analysts had expected. The vast majority of that increase coming from operating losses. Analysts also pointed out the firm's higher expense guidance for the year. Also, keep an eye on shares of what happened over at Citi. The company reported earnings earlier in the day. They did pair a rally that had taken it up 28% this year through Thursday. Shares finished the day down by 1.8%. Citigroup said that costs for the year are now likely to be at the high end of the range it previously provided after the bank faced a series of regulatory penalties in recent months. And finally, keep an eye on shares of Snowflake. I saw that Chris Palmieri was on your air a little earlier talking about that AT&T hack. Well, Snowflake shares fell after AT&T disclosed a massive hack of customer data. Bloomberg News reported that the information was illegally downloaded from a Snowflake cloud platform, citing an AT&T spokesperson. Shares of Snowflake fell 1.8%.
All right, let's get to the bond market here, guys. It's been quite an interesting week. A rally all across the curve, but it's really been that front end where you've seen consistent buying. Yields down about 17 basis points over the last 4 days. And that means you got the 210 spread continuing to steepen here. You're now down negative 27 basis points. We've been in kind of a range-bound mode, but many analysts are now looking for get into positive territory. We were talking to Tracy Chen over at Brandywine saying it's not the absolute level of the curve. It's sort of how fast we get there, how fast we get into that positive territory, guys.
Yeah, I do wonder if, folks that are watching certainly Bloomberg and looking at the rates environment, looking at the deal environment, like kind of all the stories that are coming out, maybe they're having those conversations not on the golf course, which has been traditionally the environment for folks to do so, but maybe they're actually having them on pickleball courts.
Yeah. So are you guys big pickleball players?
No.
I've tried it, but
What'd you think?
I don't know how you can have a conversation with someone because it's
Aren't you running all over the place or
Yeah.
something? Yeah.
I know it definitely doesn't have the same. It doesn't have the same sort of vibe as golf, where you're like walking with your clubs to the next hole, or riding in a car with somebody. And it also doesn't take 6 hours like a round of golf takes me, I guess.
Wow.
But
you must be a really slow player.
Is that? I've not played golf in a long time. That's when you lose as many balls as I do, Romaine. That's how long it takes.
Yeah. Well, tell me about it. I probably spent more on balls this past weekend than I did on the actual greens fees. But I am curious, to Scarlett's point, though, I mean, as somebody who's played pickleball a lot, it doesn't really seem conducive to conversation, at least not any kind of serious conversation.
Maybe the game goes quicker, and so then you hit the bar afterwards, and then you talk about a deal. Maybe it's something like that. It's more inclusive, right? You don't necessarily have to have.
It's also more aggressive,
like the skills.
though, right? It's more aggressive.
Or forget about this. We all work from home, but our new home is the French Riviera instead of our actual homes. Apparently, this is a thing. Rich Americans who can do a 4-day work week and then they can work from home the rest of the time, they're now buying a property in the French Riviera. In fact, home price values are up or above $16 million along that beautiful southeastern coast.
Okay, that rules us out because we can't work from home.
We can pool it. Oh yeah, we can't work from home. We can set up a camera. We can pool our resources. You can get like a 1-bedroom. Bunk it up.
I'm glad the French Riviera is having a moment.
Has it not ever had a moment?
That's what I'm
Doesn't
saying.
it always
That's
have
what I'm
moments?
saying.
Well, that's what I was confused about too, because they kept saying how prices are going up, and I'm like, was this ever cheap and affordable, like in the modern era?
And are they really working from home, or is it just a second property? I don't know. Are they sitting there at their computer working from home?
If you're in the advertising industry
you.
and you're going to Con Leon or whatever that advertising conference is, sure, you're working from home, sort of.
I think the distinction is that London property was up 13% in the same period, but over the last 5 years, you've had the prices there up by 20%. Well, the relative basis.
We pitched the idea of doing a remote on the French Riviera, and we got quickly some messages back from our bosses
So Paul didn't like that? He wasn't super keen?
Well,
it was let's say it was up the chain higher than that. Yeah.
And they just said, not going to happen.
Cool.
We tried. Anyway, guys, have a great and safe weekend, even if it's not the French Riviera. Be well, pickleball, golf, whatever it is. Have a good weekend. We'll see you guys again, same time, same place on Monday.
All right, our coverage continues here on Bloomberg Television. Getting back to the markets here, a big week for equities, but it was also a big week for treasuries. Treasury yields are dropping to the point where, at least on an aggregate basis now, treasuries have erased all of their losses for the year. And a lot of this has to do with recalibration of expectations for rate cuts in 2024. That is a developing story. Just a little while ago, we learned that Barclays is changing its forecast for Fed policy, predicting a second interest rate cut in December. That's in addition to the one they were already pricing in for September. Marc Giannoni joining us right now, the chief U.S. economist over at Barclays, also a former Fed economist. All right, give us a sense here as to why you think the Fed will feel compelled not only to cut once, but to do it again before we get to 2025.
Yes, good afternoon. Thanks for having me. Well, look, we got very good CPI data yesterday, as well as some producer price data this morning that suggested inflation in June actually moderated more than expected. We think this is going to help the Fed gain more confidence that, in fact, inflation is on its way back to the 2% target. So we think that with that increased confidence, and this is amid also a labor market that shows some moderation, that shows some slight cooling as well. We think that with that, the Fed is going to be confident that they are on track, in fact, for inflation to go back to 2%, and that allows them to start cutting rates in September, but then to continue with this rate cutting cycle in December as well. So we added one cut to our call, as you pointed out.
This gets to a kind of a core question that I think has been bounced around for a while, and I know Powell has been asked about this, and that is whether or not financial conditions are indeed restrictive. He was asked that question in the past and said he didn't think they were necessarily restrictive enough here to justify two rate cuts in the span of basically what would be about 3 to 4 months. You would have to assume that their stance on the restrictiveness has changed.
Yes, that's right. So that's a very tricky question. So if you look at the policy rates where they are compared to history, I mean, they look pretty elevated. And I think the Fed officials have repeated over and over again that they thought that policy was quite restrictive. And in fact, Chair Powell has repeated this quite a bit. The evidence for that is very difficult to find, but the part that Chair Powell has alluded to is looking at labor demand, like looking at job openings gradually coming down, signs of labor demand normalizing. And I think there's truth to that. I mean, the labor market as a whole is no longer as overheated as it was. It looks like now it's pretty much at full employment. And that's in part due to the elevated rates we've had. Now, the issue, though, is if you look at broader financial conditions, it becomes a little more tricky. And, we track various measures of financial conditions, and one that the Fed has been emphasizing in particular over the past year, in technical term called FCIG measures that the Fed staff has put together, and we update on a very regular basis. And based on that, it doesn't look like Fed financial conditions are particularly tight. In fact, they are close to neutral, if not slightly easy as well.
Okay. You had mentioned that the PPI report was also encouraging. Can you explain how that is to me? Because when I look at the numbers, it looks like everything came in higher than anticipated, whether it's final demand month over month, final demand year over year, or core year over year. Everything came in higher than what economists expected, except for the PPI ex food, energy, and trade month over month. That was flat. If PPI is a leading indicator for CPI, wouldn't this hotter than expected PPI report suggest the opposite of what the CPI gave us?
No, you're exactly right in describing what happened to the PPI that we got for June earlier this morning. But the way we look at it is we take first the CPI, so the consumer price index that got published yesterday, that showed a very big surprise. I mean, a surprise to the downside, and more importantly, a broad-based weakening in inflation. Then what we look at is the Fed's favorite measure of inflation, and that's the PCE inflation. So consumer prices, but measured slightly differently, that the Fed thinks is more relevant to capture really the inflation that's relevant for consumers. And that involves, I mean, one way to really gauge what these PCE inflation is going to look like when we finally get that release at the end of the month is by looking at the important component of the CPI that we got yesterday, as well as some components of the PPI that we got this morning. And when you put it all together, it looks like PCE inflation or core PCE inflation that the Fed is going to be focusing very much on is going to round around like 0.17% for June in our own estimation.
Okay.
And that involves some subcomponent of the PPI that came in this morning.
Got it. Okay. And of course, that core PCE number comes in July 26th before the FOMC decision on July 31st. Yep. So walk me through how you see this September rate cut unfolding. Is the Fed going to start positioning for that at the July 31st meeting, or do they hold off and Powell starts dropping hints at Jackson Hole?
So I think based on the recent inflation data and the PCE inflation that we'll get later this month, as you pointed out, I think the Fed will say in the FOMC statement of the July meeting, I think the Fed will say that they found the inflation data very encouraging. It's that they will also note potentially some increase in the unemployment rate that we've observed in recent months. And with that, set the stage for a possible rate cut in September. Then there will be another opportunity for Chair Powell to speak at the Jackson Hole conference in August, so that by the time we get to September, the September meeting, we expect the market expectation to really cement around a rate cut at the September meeting. So that won't come as a surprise by the time we get to the September meeting.
Marc, thank you so much for walking us through that. Of course, Marc Giannoni of Barclays now anticipating penciling in 2 rate cuts for this year. Much more ahead. This is The Close on Bloomberg. Welcome back to The Close. I'm Scarlett Fu.
And I'm Romaine Bostick, wrapping up a week. And it was a pretty wild week, but it was a week to the upside that I think a lot of investors will take. The S&P, the NASDAQ, and the Dow all finishing in the green on the day and a weekly basis, though coming up just a little bit short of another record high, particularly coming off that sell-off yesterday. But they are getting that aid from the yield picture here. That continued drop, 6 basis points on that 2-year yield. You add that to the 10 to 11 that we got yesterday here, and you get a big part of the reason why we're starting to see a little bit more enthusiasm. But of course, a big part of the story this week, Scarlett, has been that big rotation that we've seen, a rotation out of some of the big cap tech names and into something that, well, I guess is decidedly non-tech.
Yeah, and in many cases, you're going down the size spectrum as well, to mid caps and to small caps. I do have one name from the mid cap space, and this is QuantumScape. The ticker is QS, up about 17% today. It did rally as much as 22%, and it's extending its gains after yesterday the auto parts company entered into a pact with Volkswagen's battery company PowerCo. So this is the best 2-day rally since December of 2020 for QS. There was also news for Snowflake and AT&T. AT&T disclosed a massive hack of customer data that the FCC is now investigating. Bloomberg reporting that an AT&T spokesman said the information was illegally downloaded from a Snowflake cloud platform. That stock lower by almost 2%. But our top story this hour and for the next few weeks is going to be earnings. Earnings season is underway. And according to Bloomberg Intelligence, S&P 500 profits are expected to post a 3rd straight quarterly gain of about 8% over last year. But the uncomfortable reality is that most of that increase is concentrated in tech and tech-adjacent sectors. Case in point, Netflix. Its earnings are estimated to increase some 85% from a year ago, thanks to a crackdown on password sharing and the recent introduction of its new ad-supported tier. Romaine?
That is, of course, the story that is going to dominate as we close out this week and head into next week. Nancy Tengler, CEO and CIO at LafferTengler Investments, hopefully can bridge that gap for us. Nancy, always wonderful to see your smiling face on a day where I think we should all be smiling. This was a pretty good week here, a week that I think gave investors a little bit more confidence, whether it's in interest rates in that direction, whether it's in the state of the economy, or whether it's in the fundamentals of corporate earnings. Where do you want to start?
I
want to start. Hey, good to see you, Romaine. I think I want to start with earnings. I do expect that we will see some pretty powerful earnings growth this quarter, and importantly, revenue growth. So we'll be watching the big week is not next week, but the week after, and that's really when things will start to gear up. But I also think that we also have to temper some of the enthusiasm that the market has over the headlines, because we've seen pretty dramatic revisions in a lot of the economic numbers. So case in point, PPI today, jobs non-farm payrolls last week. So I think we need to see some trends and focus on earnings. And so that's what we're doing in our portfolios.
So while we focus on earnings, I mentioned how most of the earnings gain that we're going to see in the S&P 500 is really in tech and tech-adjacent sectors. For other sectors like materials, transportation, auto parts, they're still pretty much struggling along. Do you expect that to widen as we hear from the CEOs in terms of their outlook for the rest of the year?
Yeah, I'm sorry, by widen, Scarlett,
broaden out to other sectors.
Right. Yeah, I do expect that. I mean, our theme, and I've talked about it a lot on your air, is old economy companies that are pivoting to the new technologies. So at first it was digitization, then it was cloud computing, now it's generative AI and cloud computing. So I think what you're going to start to see is CEOs, and the surveys show this, that it will improve margins, and the use cases are increasing. So we think that's going to spread out into industrials, which it already has, financials, healthcare, where the usage of generative AI in product development, in client service, in productivity enhancing activities will start to trickle through or feed through to the bottom line.
Nancy, I got to ask you a little bit, though, about the moves that we saw in rates. A lot of people now having renewed confidence, we should say, that we will start to get those rate cuts that everyone had priced in at the start of this year. Only 2 right now being priced into this market, not necessarily the 6 or 7 to start the year. But did you get a little bit more confidence when you looked at the economic data, when you heard what Jay Powell had to say, that they are prepared to finally give in to what the market has been asking for?
I think so, Romaine. I mean, we've sort of said we thought September was the live meeting. And one of the reasons is, well, there's 2 reasons. The chairman has indicated pretty clearly that he'd like to cut rates. But also the Fed is holding the nominal Fed funds rate above nominal GDP. And historically, and it's not by a lot, but it is still above that level. And historically, that has not resulted in good outcomes. So we've seen recession, financial crisis when the Fed has done that. And then secondly, I think they are taking a playbook out of the 1990s. So aggressive hikes in 1994, and then 2 cuts in 95, 1 cut in 96. So if we get the productivity that we expect at LafferTengler, then I think you will see a Fed that is able to cut, but not have to cut aggressively, because I do think the economy, while softening, is still in pretty solid shape.
We talked earlier about the Russell 2000 really having its week, up 6% this week, in contrast to a 0.9% advance for the S&P 500 and a 0.25% gain for the NASDAQ. Is this rotation into the Russell 2000 for real this time?
I don't know, Scarlett. I mean, I think, you know, if you think about a softening economy, yes, if we get rate cuts, that's helpful. But we also need economic growth for these companies to perform from an earnings standpoint. So I think what we've decided, and we made this decision a long time ago, is that small caps historically have had periods of outperformance, but not sustained periods of outperformance. So we're typically light on the group, and we sort of express it within our large cap strategy by dipping down into mid and small occasionally when we find high quality companies. But I don't know. We got a head fake in the fall, and I thought, well, we were wrong about that. They really didn't follow through. And I would make the same argument with utilities, because even still, if you get 1 or 2 rate cuts, that still isn't really does not result in utilities being all that competitive with fixed income instruments. So we've purchased names like Quanta Services that are providing the infrastructure for electric utilities, but have better growth prospects than regulated electric utilities.
All right, Nancy, really appreciate your joining us and giving us some examples of what you are buying. Nancy Tengler is CEO and CIO at LafferTengler Investments. Now, we're going to stay with the markets here because StubHub is delaying its IPO launch until after the summer. The company is citing unfavorable market conditions, according to Bloomberg reporting. Amy Orr of the M&A team joins us now. unfavorable market conditions. We're talking about markets near record highs.
Yeah, well, but then it's also about individual companies and also the sector. The sector is very varied, and given that Vivid Seats and then Live Nation, which are the two closest comparables, are actually trading kind of like differently. So it's, and also StubHub itself is not doing primary kind of ticket sales, but secondary. So essentially, if you have bought the ticket and then you don't like it, you don't have time for it, and then this is the place, one of the places where you can actually go and sell your tickets.
There was a lot of questions too. I mean, and I'm glad you brought up the secondary issue, because when we talk about the regulatory scrutiny, the consumer scrutiny, and then of course a lot of the anecdotal evidence that ticket sales this summer overall aren't necessarily tracking at the sort of fever pitch that we had last summer, I guess, because we don't necessarily have all the biggest stars out there like we did. Is that going to factor into this? Do we know if that maybe played a part in their decision to postpone?
Well, for StubHub, the financials that they're going to show is going to be last year's financial, which is fantastic. What we've known so far is that their sales actually went up by 44% last year. And a lot of it was driven by Tengler, but even without Tengler, it was 30% up, so which was great. But I think a lot of people will be looking at it going forward as to where it can actually drive the sales and also how it compares and it competes with others. And it's very interesting about the antitrust lawsuit that is going on with Live Nation at the moment, whether it will have any impact or positive or negative, probably positive, but how it's going to tap the primary market is going to be interesting.
I just have to say, too, it's interesting. So you're saying 15 percentage points of that revenue growth was just due to Taylor Swift?
Taylor is Taylor.
Wow.
Yeah,
that is
an economic force.
She's an economy unto herself. Amy, great to have you here. Amy Orr, interesting story here about StubHub, Scarlett, postponing that IPO, and even more interesting, I guess I shouldn't be surprised that Taylor Swift has that kind of pull, but I don't know, when that starts showing up as a drag on your earnings, then I don't know, maybe you need a different business.
There's a give and take, right? It's going to boost economic activity last year. It's also going to be a drag on some companies' earnings, and maybe it'll change things around for the UK as well.
Have you not caught her new Eras tour? What is this called? Eras 2.0 or what?
No, it's still the Eras tour.
Just
Eras making
tour.
its way around the globe.
Just making its way around the globe here. Yeah, is it coming back to the U.S.?
You know, that's a good question.
Okay.
I don't think so. I mean, you can see it in the movie form, like on Disney Plus, or if you missed the original one, I think that's showing somewhere too.
Okay,
on your streaming services.
All right. When we come back, well, speaking of watching this on TV, we're going to take a look back at the world of streaming and on the day in history when Netflix, Scarlett, became a Hollywood A-lister. Here's a question for you: which television series helped Netflix win its first ever Primetime Emmy Award?
What TV series?
Yeah. All right, let's go back in history. This day, July 12, 2018, Netflix reached another major milestone in chipping away at Hollywood's old guard and establishing itself as a true A-lister along Sunset Boulevard. It was on this day that the Academy of Television Arts and Sciences nominated Netflix for 112 Emmy Awards for a single year. That was more than any other network ever, and by default, that set a new high for a digital streaming platform. In fact, it was a banner year for the digital barbarians at the gate. Streamers that had amassed the subscribers, they had amassed the critical acclaim, but not necessarily the industry validation. That changed in 2018. That was the same year that Apple got its first Emmy nomination for Carpool Karaoke. That was the same year Amazon won Best Comedy for The Marvelous Miss Maisel. That was the same year that The Handmaid's Tale contributed to 27 nominations for Hulu. And the accolades that followed a rapid ascent for Netflix, which was spending upwards of $8 billion a year at the time to sign big-time producers, comedians, and actors for original TV shows and films. The most nominated show in 2018 for Netflix was The Crown, with 13 nods, with additional nods for Stranger Things and for the women's wrestling drama Glow. In all, streaming services overall combined won 12 of the night's 26 featured awards and 35 in total, both new records for digital streamers. And that brings us to our question of the day. 5 years prior, on 2013, Netflix became the first streaming platform to win a Primetime Emmy for an original TV production. Which show helped them achieve that milestone? The answer? House of Cards, the political drama nabbing a Best Director Emmy for David Fincher. And since then, Netflix has won 160 Emmys, including Best Show awards for multiple episodes of Black Mirror and for documentaries like Making a Murderer. It was a staggering ascent from Silicon Valley startup to Hollywood insider, an evolution not lost on the comedian John Mulaney, who, when he won an Emmy in 2018 for his Netflix stand-up special, he accepted that award and ruminated on how a DVD mail-order business could rise to become a dominant Hollywood player, quipping that it's like Columbia House becoming the biggest studio in the world.
He always has the best lines. House of Cards, I feel like that's the weakest of all those Netflix shows. I mean, it's the biggest one in terms of making a name for itself. But Kevin Spacey is persona non grata in Hollywood now, and I don't know. I don't think the show has stood up the test of time very well.
Yeah, it didn't. But I will say that was the first big series that like drew me into Netflix, as I think it did for a lot of folks. That was when I really kind of was like, oh, I need to subscribe to this.
And also having David Fincher, direct the series, that was like a home run.
Yeah.
All right, let's stay with Netflix here because the company reports its quarterly results next week. And joining us now with a preview is Alicia Reese, VP of Equity Research at Wedbush Securities. Alicia, we know that the results for Netflix will definitely get a boost from its effort to crack down on password sharing. And that'll result in new subscribers as well as the growth of its ad-supported tier. I'm curious to hear from you, what does the trajectory of this benefit look like? How long does this go on for? How long is this tailwind?
Sure. I think most of last year we saw the benefit of the password sharing crackdown, and that was on two sides. One, the people who were cut off from the shared accounts so largely signed up for their own accounts. Many of them also got to join their family accounts as an extra member, and Netflix's ARPU was driven higher by that. And that offset some of the declines that Netflix saw in its ad tier. The ad tier has been dilutive for over a year now. And so the ARPU was impacted a bit by that, as those who were kicked off the shared accounts added their own cheaper ad-supported account, only $6.99 a month in the U.S. And so that's been great for reducing churn, for adding new subscribers. It's been a little tough for ARPU, but now in 2024, we're starting to see the ARPU is starting to be a little less damaged by more ad tier users, and it's getting closer and closer to accretion. And I think that's the 2025 story, is that it becomes accretive and the stock starts moving again in that direction because Netflix is able to prove how profitable the ad tier can be.
Well, just on that point, too, I mean, there's been a lot of anecdotal reports of people saying that they're kind of being nudged into that ad tier, people who are now paying for even the premium thing, logging into their accounts and then getting a prompt from Netflix to do that. So it's not just that they're trying to get new folks onto that ad tier, but they seem to be trying to pick people from the premium plan to the ad tier. Are you finding evidence that that is a deliberate strategy?
I don't know. So what we're seeing, at least in our survey work, is that instead of churning, when people have maybe fewer shows that they want to watch, they'll opt instead for the ad tier because it's cheaper. And they'll hang out on that for a while, they'll watch it. But if there's a lot more they want to watch, they'll often go back to the premium tier. And I think one of the reasons for that is perhaps that you can only watch on 2 devices on the ad tier, and you can watch on 4 or more. So if you have a large family and people are using a variety of devices throughout the house, you want to have that premium tier. You also have HD for those really, high quality shows. So I think over time, Netflix is going to encourage more people to choose the ad tier by increasing the 1080p to HD and increasing the number of devices. They also are going to keep those ad rates extremely low. So it's not intrusive really to be on the ad tier and not just choose that as, instead of churning, but to stay on there for a longer term. So that hasn't happened yet. We're still seeing a lot of people choose the ad tier and then opt back for the premium tier later. But I think over time we'll see that more.
So Ramin mentioned John Mulaney, and of course he's had a couple of Netflix specials, and he's also done some stuff live as well. These live events, whether it's sports, WWE, the NFL, or comedy, when does this become a meaningful revenue generator?
Right. So far, they've just been testing it. They haven't had a ton of viewership on the ad tier so far because they haven't had that many members on the ad tier so far. They also haven't had a lot of advertisers yet because they haven't had a ton of partners. So they've been building that over the last year. And more recently, their recent upfront, they discussed far more partnerships that they're gonna experiment with and just broaden their appeal to advertisers with a lot more targeting capabilities. What they're going to do year end in December is do the 2 NFL games and then So that's going to be advertised across the board to all tiers. And then WWE, that's a weekly, the weekly SmackDown show. That's going to, be at least once a week. That's going to be a live, ad-supported broadcast to all tiers. Outside of that, there's a lot of shoulder programming for the WWE, but in essence, that's going to give Netflix a significant opportunity to advertise and really grow its advertising base and just add more live events, live shows of various sorts for the programming. And that's really where they start building it out, I think, is early 2025, and that just expands from there.
All right, Alicia, great stuff. We're definitely going to circle back to you after those earnings to get your thoughts here on what we actually learned. Alicia Reese, VP of Equity Research at Wedbush Securities. We should point out Netflix earnings scheduled to drop next Thursday, July 18th. After the bell, we'll have full coverage right here on this program. We do want to stick with this topic and stick with Hollywood and talk a little bit about production and the use of AI. How it became one of the most controversial issues, particularly last year, that led to those strikes by writers and actors, strikes that have, at least for now, been resolved. Here to talk a little bit about what we know and where we've come since then is Duncan Crabtree-Ireland. He's the National Executive Director and the Chief Negotiator for the main union representing actors, SAG-AFTRA. Duncan, great to see you once again here. It's been, I guess, about a year since the strikes kicked off last year. I know AI was a big topic of conversation. You had those provisions written into those new deals here. Based on where we are now with production back up and running and now a much broader discussion about AI, are you still happy with what you negotiated?
Yeah, I mean, I think what we negotiated last year has really set the floor from which we've been able to continue to bargain upwards. I mean, since that time, we've negotiated new agreements with the studios and streamers covering television animation. We negotiated our sound recordings code with all the major record labels and other agreements as well, all of which contain AI protections that are based on those fundamentals and that are starting to evolve along with the technology. So I think they provide a really important set of rules and regulations for the industry that have already served us well. And now we're focused on getting public policy to keep up with the collective bargaining achievements so that we have the kind of protection for all performers and really all of us that we need both within and outside collective bargaining.
Well, let's talk about that, because I feel like last year when we had you on around these strikes, we talked primarily about the actors themselves. When we talk about voiceover work, obviously that's it's close to home for television anchors here. When we talk about those protections, or not just protections, but the idea that if you are going to use AI or use some sort of technology that's going to take advantage of my voice or Scarlett's voice in some way or another, that at least there's compensation for that. Are those protections there right now?
They are there within the scope of the collective bargaining agreement, not only compensation, but also consent and informed consent, so you know what that use is going to be. But it doesn't really exist outside of those collective bargaining worlds, outside of the world of our members and people who are working with companies that have contracts with us. And so that's why we've been pushing for legislation at the federal level to establish that all of us, not just actors, but everybody, has a right to control the use of their image, voice, and likeness. And this is going to be really important, not only for performers, but for everybody, especially also broadcast journalists, who we also represent, as you know, also reporting artists, just everyone, because we should all have the right to say if someone can use our face or our voice to say or do something. And that's what we want to put in the law.
And a perfect example of that is NBC bringing Al Michaels back for the 2024 Olympics and using AI version of Al Michaels and customizing reports to customers of the Olympics package that NBC's offering, using Al Michaels' voice to come up with like a wrap of the day's events. Is that more of what we're going to see? Is that something that your members want to be a part of, that they want to get offers to do?
Well, I think I think companies are experimenting with that, and we're going to see how the public reacts to that sort of content. But if our members' image, voice, and likeness is going to be used to do that, for sure they want to have the right to consent and to say yes or no to it and to be compensated for it. And in that example, that's exactly what's happening. But with deepfakes, there's all kind of abusive uses that are going out there. I myself was deepfaked during our contract ratification. Someone made a video of me saying false things about the contract. And there's no federal right that protects against that now. That's why we need some action at the federal level to get this addressed.
Yeah, and let's be clear that Al Michaels, of course, was asked to approve the use of his voice by his employer, NBC, here in this case. When we take a step back here, you look at production in Hollywood right now, the impacts of the cutbacks in production spending following the strikes last year are definitely being felt. The number of global film and TV productions down about 20% from 2022 and approximately 40% in the U.S. Was this what your union expected, your union members expected?
You know, I don't think it's what we expected. I think everyone recognized that there was going to be some slowing down in the rate of production, you know, sort of coming off the tail end of the streaming wars and the battle by these big streaming companies to establish dominance in the streaming space. But also, clearly, there's been some additional impact, especially in the West Coast. We've seen higher levels of production in the East Coast and other production centers in the U.S. But the reality is there is a huge hit that's been taken. It's unclear how much of that relates to ongoing collective bargaining that's been happening with the crew members, including IATSE and the Teamsters. Those contracts expire soon at the end of this month. So, and the IATSE contract has already been successfully negotiated. The Teamsters are in there bargaining right now. We're standing side by side with them. So hopefully, once those contracts are done, we'll be able to really assess what the ongoing level of production is going to be. And I certainly hope that it's going to ramp up.
Got it. All right. Thank you so much, Duncan. Really appreciate your joining us today. Duncan Crabtree-Ireland is National Executive Director and Chief Negotiator for SAG-AFTRA. And of course, in terms of must-see TV for a huge number of people remain, this Sunday at 3 p.m. Eastern time is going to be must-see TV when it comes to the Euro Cup final, Spain versus England. The climax of 28 days of drama, more than 80 hours of soccer. From 24 teams down to 2. Did I make that exciting enough?
Yeah, well, I don't follow this real well, but I have a lot of friends who are non-American, and I was wondering why they were all ghosting me this weekend, because apparently they're all basically having their big parties here. I'm actually really intrigued by this matchup, obviously England, Spain, but I'm more interested in the Spanish story, because they were kind of like not really considered even like really viable at the start of this tournament, and now they're the favorites heading into the big event on Sunday here. And of course, we talked, I think, the other day about
the 17-year-old
16. Right? Did he turn 17?
Yeah, he's turned 17 today.
So,
I think.
Well, very good. So this could be a nice birthday present for him if he manages to win on Sunday.
You know, but I'm curious to see what's going to happen with England here, because they played Italy in the Euro Cup 2020 finals, which took place in London, and there was a Netflix documentary on the match where you had drunken, coked-out England fans partying in the hours before the match. They broke through the barricades. It looked like January 6th, to be honest, and they forced their way into the stadium to watch the game. And the documentary talked about how the folks who worked at Wembley were really scared something bad was going to happen, except that England lost the match. So all the fans were kind of like, oh, disappointed, and they just turned around and walked home.
All right. Well, I don't know. We're going to get a repeat of this. I guess the match takes place in Berlin, so is it going to be...
Are the Germans going to be prepared for American fans?
And I guess the Germans don't really have a dog in this fight, right? It's just the Spanish.
The Germans are always prepared.
But, all right.
They'll be prepared for this. I'm sure of it. Let's take a look at how markets closed on the day. That rally, we resumed it.
Yeah.
The July rally's intact again.
Yeah, I mean, look, this is impressive. I mean, we're going to obviously pick this apart because that's what we do for a living. But when you look at the gains on the week, 2 straight weeks of gains, but more importantly, the idea that the breadth we had. And I was looking at it. I mean, this was 3 straight days where you basically had roughly 80 to 85% of the members in the green. Now, I know that didn't always translate to monster gains. And yesterday, you actually had a loss on an aggregate level. But that's the broadening everyone was waiting for.
A 6% advance for the Russell 2000 for the week. The question is this sustainable? Is this a real marking? Does this really mark a turning point, or is this yet another head fake?
Well, I think a lot of the answer to your question really has to do, I don't know if it's up there on the screen, but really has to do with what we saw in the yield space and that drop. And I think that really gave people the confidence to go back into some of those cyclical names.
Yeah, but we'll see, because earnings season starts, and people get excited about certain companies reporting.
I thought earnings season never ended.
It actually technically doesn't. This is the close on Bloomberg. Following his NATO news conference last night, where he displayed mastery of foreign policy nuances, but then flubbed the name of his vice president, President Joe Biden is forging ahead with his fight to stay in the White House. He's campaigning in Michigan today, but he's still facing skeptics from within his own party. Bloomberg's Kelly Lyons, the co-host of Balance of Power, joins us now. What is the count up to now, Kelly, in terms of Democrats who are pushing President Biden to step down from the ticket?
Well, we have 19 sitting members of Congress, 18 of those members of the House of Representatives, Scarlett, just one senator to this point. But the list just continues to grow, even in the aftermath of President Biden's press conference. Just moments after it ended, Congressman Jim Himes, who is the highest-ranking Democrat on the House Intelligence Committee, he's the ranking member, called for him to step aside. And we've seen a few more trickle out throughout the course of the day today, the latest being a frontliner, Congressman Mike Levin of California, who, according to our reporting, was on a call that Biden was on today with members of the Congressional Hispanic Caucus's campaign arm and told the president he needed to step aside, and the call ended entirely shortly after that. So Biden clearly on that call and others that we understand he's had throughout the day today virtually as he campaigns in Michigan has been trying to assuage the fears within his own party. The question is whether or not he ultimately can be successful in doing so when it wasn't just about one press conference. His every move and every utterance, frankly, is going to be watched from here on out.
It certainly was ad nauseum. Of course, we still got about 5 weeks before we get to the Democratic National Convention. Of course, a big decision that has to be made about who they want at the top of that ticket. The RNC convention, though, a lot closer, Kaylee. That starts next week here. We pretty much know who's at the top of the ticket. Have we gotten any indication yet as to who the running mate for President Trump might be?
No, we don't know for sure, Romaine, and you're right. This starts on Monday. We are going to find out who Trump's VP pick is at some point, considering he has to be there when the roll call, or they have to be known when the roll call is ultimately called at the convention. What Donald Trump has continually hinted at is that he does have a group of, say, 4 or 5 that he is looking at closely. They include Senators Marco Rubio of Florida, J.D. Vance of Ohio, Doug Burgum, the governor of North Dakota. Those seem to be highest on the list, though there are others in the mix as well, including South Carolina Senator Tim Scott. He's keeping us guessing, though, and actually in a radio interview just today, he was talking about how this is kind of like a version of The Apprentice, the reality TV show we all know he hosted for some time. He is really capitalizing on drawing this out and has said repeatedly he wants to be able to announce it in the middle of the convention to improve ratings. So that gives you some idea of how he may be thinking about it. I would just point out, though, that strategists we've talked with in the last 24 hours, in the middle of this uncertainty around whether or not Joe Biden will be continuing at the head of the ticket for the Democratic nomination, all of the polling the Trump campaign has likely done is with Trump and his VP pick against a Biden-Harris ticket. And it becomes a little more uncertain how well this Trump ticket could do if they were up against someone else.
All right, a lot of decisions to make for both political parties here as we enter really kind of the meat of the political season. Of course, the RNC convention kicking off next week, DNC about a month after that. You can catch all of your political coverage on Balance of Power. That starts at the top of the hour with Kelly Lyons and Joe Matthew. And this gets us to a big question here as to whether the market is going to start to obsess over politics the way the media has been.
Well, you know, we're members of the media, and we ask all our guests what they think about this. And they're always like, oh, it's still too soon to do anything about this, or it's still too far away. And so clients aren't necessarily asking us about this. I did find it interesting that a lot of folks say that European clients or overseas clients ask a lot of questions about this, because the Europeans know, the leaders of those countries know that whether it's Biden or Trump, they're going to have to carve out a new path.
Yeah, and when you talk about policy differences, certain foreign policy is probably one of the bigger gaps between those two candidates. We're going to set you up for the market moving events over the next week when we come back after the break. Stick with us. This is The Close on Bloomberg.